This piece covers one of the most widely misunderstood personal finance topics. What actually happens to your debt when you die? Most people believe either that debt dies with them or that it automatically becomes their family's problem. The reality is more structured and, in most cases, more reassuring than either extreme, but with important exceptions that can create genuine hardship if you're not prepared. When you die, your assets and your liabilities together form your estate. An executor, named in your will or appointed by the court if there's no will, takes legal responsibility for the estate. The executor's job is to identify all assets, notify creditors, settle debts from estate funds in the legally required priority order, and then distribute whatever remains to the beneficiaries named in the will or determined by the rules of intestacy. The priority order for paying debts from an estate is not arbitrary. It's determined by law. Funeral expenses and estate administration costs come first. Then secured debts, which are claims against specific assets. A mortgage is a claim against the property. A car loan is a claim against the vehicle. Then taxes owed to HMRC or the IRS. Then unsecured creditors, credit cards, personal loans, medical bills, in the order they submit their claims. Beneficiaries receive whatever the estate holds after all valid debts are settled. An insolvent estate is one where the total debts exceed the total assets. In this case, creditors are paid in the priority order until the estate runs out of money. Unsecured creditors at the bottom of the priority queue may receive very little or nothing. The crucial point, the shortfall, is written off. Family members who are not co-signers or joint account holders do not become personally responsible for the unpaid balance. The debt simply ends. Secured debts work differently because they are tied to a specific asset. A mortgage doesn't become an estate debt to be settled before heirs receive anything. It stays attached to the property itself. The property and the mortgage are linked. Similarly, a car loan stays with the vehicle. If there's a co-borrower on a secured loan, that person retains full responsibility for the full remaining balance. The death of one co-borrower does not forgive, reduce, or defer the other's obligation. When there's no co-borrower on a mortgage, the heirs of the estate who might inherit the property have a decision to make. They can sell the property and use the sale proceeds to pay off the remaining mortgage balance, taking any equity as part of their inheritance. They can choose to refinance the mortgage into their own name, keeping the property and assuming responsibility for the loan. Or they can choose not to take on the property or the mortgage, in which case the lender can initiate foreclosure proceedings to recover the secured debt. During the estate administration period, mortgage payments must continue to be made or the lender will move toward foreclosure. Unsecured debt in your sole name, credit cards, personal loans, medical bills, does not transfer to your family unless they were party to the debt. Creditors are legally entitled to claim against your estate, and they will do so. But their claim ends at the estate boundary. If the estate pays out to them, that's the process working correctly. If the estate is insolvent and they receive nothing, they have no legal route to pursue family members who did not sign for the debt. Your adult children are not responsible for your Visa card balance, even if you use that card partly for their benefit. The key distinction on credit accounts is between joint account holders and authorized users. An authorized user can use the account but did not sign a credit agreement. They have no liability for the balance, not during your lifetime and not after your death. A joint account holder signed the same credit agreement you did. They have equal liability for the full account balance at all times, before and after your death. Co-signed loans are the clearest and most consequential exception to the principle that family doesn't inherit debt. If you asked a parent or child to co-sign a personal loan or student loan, that co-signer agreed to full personal liability if you couldn't pay. When you die, that is exactly the situation that triggers. The surviving co-signer becomes solely responsible for the entire remaining balance. The creditor will contact them directly and will expect payment. Co-signing is not a formality. It is a commitment to personal liability. Student loans have rules that vary significantly by type. UK student loans are income-contingent repayment instruments. They are written off entirely on the borrower's death. No estate payment, no family liability. U.S. federal student loans have a similar death discharge provision. Private student loans are much more varied. Some private lenders have death discharge policies that work like the federal program, while others do not. And some have cosigner requirements that make a parent personally responsible for the full balance regardless of how the loan is documented. In the United States, 9 states are community property states: Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, and Wisconsin. In these states, debts incurred during marriage are generally treated as joint marital obligations, meaning a surviving spouse may bear liability for a deceased spouse's debts that were incurred during the marriage even if they were not on the account. This is a meaningful exception to the general principle and applies specifically to the marital relationship in these jurisdictions. It does not apply in England and Wales, where marital status does not by itself create liability for a spouse's debts. Creditors of a deceased person have legal routes to pursue their claims through the executor and the estate administration process. They can submit formal claims to the estate. They can challenge executor decisions if they believe assets are being distributed improperly. What they cannot legally do is contact grieving family members and demand payment for debt that is solely the deceased's obligation. Consumer protection regulations in both the UK and the US prohibit misrepresenting who is legally responsible for a debt. If you receive a call from a creditor after a family member's death demanding payment for their personal debt, you are not obligated to respond with anything other than, "Please direct your claim to the estate executor in writing." You do not need to engage, you do not need to provide financial information, and you should not make any payment unless you were an actual joint holder or co-signer on that specific account. Write-off of an insolvent estate's debt is part of the lending industry's risk model, not a cost you need to absorb. Taxes owed to HMRC or the IRS do not write off at death. They are estate obligations that must be settled in priority order before any beneficiaries receive anything. An executor who distributes the estate to beneficiaries without first settling tax liabilities can become personally liable to the tax authority for the unpaid amount. Tax debts are not the same as commercial unsecured debts. They have higher priority, and the tax authority has enforcement mechanisms that standard creditors do not. Pensions and retirement accounts with named beneficiaries typically sit outside the estate entirely. In the UK, most defined contribution pension schemes are distributed according to the scheme's own nomination process, not via the will. The pension provider contacts the nominated beneficiary directly. These funds generally bypass estate debts, though the trustees have discretion. Named beneficiaries on pension accounts should be reviewed regularly and updated after major life events. Life insurance policies work the same way when they name a specific beneficiary rather than my estate. The payout goes directly to the named person. It is never part of the estate and is therefore not accessible to creditors. A policy that names my estate as the beneficiary goes into the estate pool and is available to creditors like any other asset. The structure of your beneficiary designations is as important as the existence of the policy. The estate planning implication of all this: unsecured debt you never plan to repay in your lifetime will still reduce what your family inherits. A £50,000 credit card balance built up over years of minimum payments will be paid from your estate before your beneficiaries see anything. If your assets are modest relative to your debts, beneficiaries may receive significantly less than you intended, or nothing at all. A will governs what happens to assets within your estate, but the will is only one track. Financial products like life insurance policies, pensions, and retirement accounts have their own beneficiary designation mechanisms that operate independently of the will. The combination of a well-structured will and appropriately designated beneficiaries on insurance and pension accounts can substantially protect family members from the impact of estate liabilities, because money that goes directly to a beneficiary never enters the estate pool. The joint debt trap. People often co-sign loans to help a family member who would otherwise not qualify. A parent co-signing a child's car loan, a child co-signing an elderly parent's credit line. The intention is supportive, but the legal commitment is absolute. If the primary borrower dies before the debt is repaid, the co-signer inherits complete responsibility for the remaining balance, regardless of who was making the payments, regardless of who benefited from the loan, regardless of what any informal family arrangement said. The legal document is the only one that matters. Summary: debt doesn't die, but it doesn't automatically transfer either. Your estate pays what it can, in priority order. Unsecured sole name debt that exceeds estate assets is written off, not inherited. Secured debts stay with assets. Joint debts and co-signed loans become fully the surviving signatory's responsibility. Life insurance and pension nominated beneficiaries bypass the estate entirely. The structure of your estate, not just its size, determines what your family actually receives. Full guide at realsyllabus.com/finance.